Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Michael Lane, Head of Asset Management at SEI, Dave Donahoo, Head of America's Wealth Management Alternatives at Franklin Templeton, Taylor Ranney, Senior Vice President of Business Development at RecShares, and Mark Gleason, Head of Multi-Asset Business Development at Alliance Bernstein. We're here to discuss investor demand for alternative investments and how this puts pressure on RIAs to offer access to private markets. It is great to have everyone with us. We've got a lot to get through. Michael, I'm going to kick it off with you. This demand for something else besides 60/40 has really heat up over the past few years. Why do you think you're seeing more personalization as it relates to getting access to alternative markets?
And we have seen an increase. Even if you look in 2022 and 2023, we only saw about $5 billion being invested in private equity among independent advisors. First half of 2024, you saw $9.1 billion. And so for the first time, we're seeing real flow going. And so is that investor demand? Is it investor awareness? Or is it the financial advisors, the RIAs, are seeing a change in the way that people develop products for them? And my fellow panelists, I'm sure, will have a comment on that too. It used to be, if you look back at the, back 10 years ago, RIAs were the last source that you would go to for capital. Mm-hmm. It's becoming the first source.
Yeah, which I think is interesting. And when you think about allocation here, Dave, when you're getting out of that 60/40 framework here, liquidity is often one of the concerns that you have to address.
It's a concern that needs to be addressed, but the industry has addressed it. I loved Michael's point. And if I think about the adoption of private markets, which is where we focus our time in the alternative landscape through the RIA community, it's being driven by three things. One, the investment case, which has never been stronger. 90% of companies generating $100 million of revenue in the US, privately held. 90% of real estate, privately held. Private credit has grown tremendously. So if you're not investing in the private markets, you're missing the opportunity set. But the challenge has always been, it's manual to access these vehicles. I can't access them across the totality of my client base. I can't do this efficiently, and RIAs have to run efficiently and scale. That's where technology, and Michael, your organization plays a big role in this, has helped make the process streamlined and more scalable. And then you've had asset managers focus on custom building product for the RIA community that lets, Jill, to your question, liquidity in and out of the vehicles more frequently.
Right, and Taylor gives them a way to differentiate their businesses as well for the RIAs.
Yeah, absolutely, and I think liquidity is an interesting piece, right? You guys are focused more on private markets. At Rex, we're focused more on liquid alternatives through derivative income strategies, but I think the evolution of what an alternative is a really interesting point here, because you mentioned access, right? Now there are platforms that allow you access to private markets, but you also have a lot more innovation in terms of products through vehicles, right? So you have a lot more liquid alternatives. We've seen massive growth in that space. We were talking earlier, right? CLOs, once 5 years ago, probably were non-existent in that structure. Now you have one product with over $20 billion. You've seen options-based covered call strategies in an ETF format. 5 years again, $3 billion, something like that, over $100 billion now. So you have the access piece and then you have the education piece. And I think marrying those two is where you actually start to see success from the asset manager side. And it's that constant feedback loop between RIAs and asset managers to identify what that next step in product innovation is.
Yeah, and Mark, I would argue too that investors have more exposure now, and they're hearing more about these products and aren't so reliant just on getting information from their advisor or from the institutional community.
Yeah, no, I think the pickup's been huge. It's going to continue to be. I think to Taylor's point, evolution is the word that at least we point to. Private credit, private equity is sort of this monolith. We're going to buy private. Now it's a lot more nuanced discussion. Should you buy some asset-backed private lending? Should you do commercial only, CLOs, et cetera? So I think that's going to continue to bifurcate, and people are going to get smarter and are going to use more of these private assets as a result. And I think, to Taylor's point, when you think about what's become more liquid and more user-friendly for RIAs and for clients that maybe aren't QPs or maybe aren't accredited investors that want to get access to defined outcome or buffered strategies or covered call, or even, you've seen a lot of big trend managers come to the market, daily dealing, some more risk parity type stuff. So yeah, I think access, demand is there, and I think that asset managers are meeting that demand by really diversifying the lineup and providing a lot of education and different opportunities for clients.
And we're seeing that in the interval structure too. When you're talking about different structures, even in private markets with an interval structure, with 80, I think it was 80 new products launched just last year, that is creating an opportunity to hold those within model allocations that didn't exist before. It was just difficult from a liquidity perspective, both in and out because of subscriptions.
Yep.
That's evolving, and that's going to make it much more mainstream of a hold in a portfolio.
I want to pick up on, you said opportunity, which is, if we think about this from the RIA's perspective, there's so much choice now, which is where it becomes a big problem. But at the same time, I would reframe that to an opportunity, right? Because if you're an RIA, realistically, a large portion of your investment returns can be done through passive ETFs, right? But you want to start to differentiate yourself. And so it's an opportunity for RIAs to do that because everybody can do passive ETF exposure in an asset allocation. And so now all of a sudden, and an example I'll give you guys is I was working with an RIA out in New Jersey, and the one guy I was speaking with basically said, look, we need to kind of differentiate ourselves. We're going back into growth mode. What we want to do going forward is every month we're going to have our investment committee meeting. We're going to bring in a new asset manager or new issuer or alternative manager, and we're going to have you sit down with our investment committee for part of the day and just talk about product development, talk about what you have, talk about use cases for our end advisors and what you're seeing in the market. And I think that's an incredibly smart way for them to be doing that, because otherwise they're never going to be able to educate themselves and keep them up with the level of product development that's going on.
I also think we have to acknowledge, Mark, that the composure of the market last year versus this year is completely different. And part, of the talking point was you want to find some assets that are not, so correlated to the market. How has the performance, has it lived up to,
I mean, look, dispersion exists within everything, but I'd say broadly speaking, if you're an alt investor, you're very happy that you're an alt investor year to date. Private credit's done exceptionally well. Some of these option-based strategies have done exactly what they're designed to do. You have, pockets of weakness, but generally speaking, I think all investors have been very happy with their Q1 performance, and it underlines again, and I think it's very true on a go-forward basis, where it doesn't look like stock volatility is going to recede anytime soon. The bond volatility and correlations have been elevated now for a couple years. There's inflation concerns, all the things we can talk about in capital markets. Yeah. All of those, at least in my opinion, should drive an investor towards a bigger allocation to alternatives, whether private or public.
Yeah.
Jill, I think Mark's spot on there, and it ties back to something that Taylor said, right? If you think about one of the powers of private markets, one of the biggest components of private markets is that they price off fundamentals. They don't price off market sentiment or technical factors. So what we're seeing in the world today, if an individual RIA has chosen to differentiate themselves, right? Like I have two little girls. I have a 4 and a 7-year-old. They play soccer, and I don't know the last time you went to a 4 or a 7-year-old soccer match. But you have a ball and you have 12 kids circled around it kicking each other in the shins. And what we talk about is separate yourself from the pack and go to where the ball is bouncing. RIAs who are doing that in private markets and have allocated to it see their quarter-end conversations with end clients going a lot easier because they have not introduced the volatility that they do with a 100% public market portfolio. And I think it gets to differentiation, and I think it gets to Mark's point on returns overall in a total portfolio approach, which is so important.
And I think it's a very smart point that you made as it relates to fundamentals, because the general public equity market right now, it just seems like a guessing game, right? And what the next headline is going to look like. So the fact that you're focusing on the fundamentals of the underlying exclusively is a big factor in my mind. I want to go back to Michael, to a point that Dave had made earlier about how technology has helped the business to evolve, not just specifically to alternatives, but to the space in general.
And it has a big impact on alternatives. It will have a big impact on alternatives. If you think about the different structures, and if you were to segment the clients of an RIA, you take the 5 million in investable assets and up and 5 million and below. The 5 million and up, you had QP products and they could access those. The 5 million and below, it was difficult. How would you actually access? You'd have the accredited investor that you could access certain products for, but the goal was to make it simpler, not even need documentation. Be able to create a portfolio, rebalance that portfolio, and how do you do that? The technology had to evolve, and it's evolving now, but depending upon your segmented clients, you have different structures that will work for each now, and the technology is going to have the capability. We talk about liquidity, and illiquidity is going to be a super important part of this. You're going to have both the private market product and a liquidity proxy for that, and you're going to hold those in a pairing, and that will give you the ability to rebalance more frequently using the liquidity piece of that sort of proxy for it. And that's going to become a very important part of providing access to private markets for any investor of any size without the fear of liquidity, because you're going to have liquidity to be able to rebalance.
Yeah.
Should that be done in the tech side or within a within a structure, like a fund structure?
So I actually believe it should be done within the tech side. I believe that holding the portfolio from a technology perspective, being able to buy, if you wanted to have 10% in private credit, and you said, well, I'm going to put 5% in private credit, I'm going to put 5% in a proxy for private credit in a liquid ETF. That gives you the full 5%. If you look at a lot of the products that are being created within a single structure, you're getting maybe 10% of the private credit, 90% liquidity because of the ETF structure.
Right. Yeah.
So I think that actually holding it in a model and the allocation being supported by the technology is actually going to be the more critical component.
The technology enables the rebalancing from a
100%.
model perspective. The vehicle itself, because our earlier comments, right, and we have these conversations frequently, a private credit vehicle or a secondary private equity semi-liquid vehicle has to hold 10 or 20% in liquid assets to honor quarterly redemptions. But if you can bring that level down by technology enabling a way to implement a total model and the quarterly rebalancing off the liquid side, I think you're going to see massive, to Michael's point, massive adoption of that in the next several years in the industry.
Agree, because if you can reduce the amount of liquidity necessary by having a liquid proxy, then your only liquidity need is going to be when you have significant drift in the portfolio. And then you might have to ask for a subscription for a redemption to get you back. But that's going to be more infrequent than a quarterly basis.
So, which is interesting because I think we're talking about this topic without even having to be asked, but what are some of the challenges that RIAs are facing when they're looking to incorporate these into portfolios? And it sounds as if you've addressed some of those from a management perspective.
Yeah, we're addressing. Part of what we did is we both have the ecosystem with custody and wealth tech, and as well as an alts platform and a models warehouse, which is what SEI 30 years ago was one of the early movers in. So when you have that entire ecosystem, you actually can make it easier to buy the alternative investment within the portfolio and then rebalance.
Yeah. What kind of challenges are here?
I mean, I think education's obviously a huge thing we talk about. We kind of think about it in two primary kind of paths. One is what Mike's talking about, right, which is you've got a different liquidity profile, you've got probably different fees, a subscription and a redemption cadence that, if you're not used to investing in alternatives, is going to be different and new, right? I have got a capital call. What does that mean? How is my incentive fee calculated? All of these are great questions that you're going to get from people who aren't power users of alt or haven't been for years, that I think the tech can solve a lot of, and then I think it's education. And then I think you have just sort of a broad asset manager investment perspective, which is a lot of these strategies are not easy to benchmark. They haven't been used for decades. It's not, I've got a US large cap manager, how to do versus the S&P 500. What's the appropriate benchmark for some of these strategies? Who are the peers? Am I doing well? Am I not doing well? My private credit fund was up 1% Q1. Is that good? It feels good. Is that good? So I think there's a lot of that type of sort of investment related education and how to think about it in an asset allocation and what performance should look like, setting expectations appropriately, where frankly from an asset manager perspective, we feel like that's our job, right? We don't want people to buy a product and a year from now, we're really happy with how it performed, and the client says, I don't really get it. So that's where the other piece of the education for us really comes in.
And Taylor, it's almost like you're drinking water from a fire hose because there is so much product. You mentioned this before, that there is so much product out there. So how do you, when you think about the nuances with each client, select those strategies?
So I think there's a couple ways to go about that, right? If you think about what you were just speaking about in terms of, options out there, I think it becomes a little bit more difficult from an education perspective because there's two pieces to it. One, you have to understand the actual investment. And two, you have to understand how it fits within a portfolio. You have the tech complications, which are an entire thing on its own. But for an advisor or an RIA who, as we all know, nowadays is kind of the first mover, they're more comfortable getting into products, but they don't have a full-blown home office due diligence team. And so in certain cases, an RIA is one person. In other cases, they're massive and they're almost aligned with a big home office. But that all of a sudden, the burden lies with that one person or those few people. And so it becomes incredibly difficult to A, understand the product, and B, figure out how it fits. I think there are just so many nuances with what the challenges RIAs have to deal with.
And that's super important, and that's one of the reasons why we've used the word access here a lot, which is ironic because that's the name of our alts platform, is access. And what you're saying is super important, and why we did what we did is, if you look at the history of SEI, it was a fund-to-fund manager. It was a group that was doing manager research day in, day out. So not only do we have the menu of those alternative options, but then we have a curated list that enables you to let us do the due diligence on your behalf to tell you, if you wanted private credit, private infrastructure, real estate, whatever that is, there's a curated list that the people who are doing manager selection for a living actually are participating in that.
Yeah. I want to go back to all the products that are available. Where do you see the most flow or going to?
So if we head back to like where the ball is bouncing,
Right.
if you look in private markets, private credit has grown incredibly over the last decade. And when we say private credit, this gets back to the education. Private credit means different things to different people. So private credit direct lending, a private credit manager loaning to a company, that's grown incredibly over the last decade. Why? Banks post the GFC had to retrench and regulation pushed them away from that business. Borrowers, companies found it easier to borrow in the private market, so it grew. Today, we see private real estate debt, the process of lending to somebody who's buying a property, growing the same way private credit direct lending did over the last decade for the same reasons. Most of the lending has been done on real estate by small and medium-sized banks. Post Silicon Valley Bank, that's gone. Some of the office challenges have forced banks to really dry up liquidity for lending altogether. And you have a large portion of borrowing that needs to happen, not just in office, but in areas like multifamily, apartments, in areas like industrial, warehouses, where the private markets are stepping in. So as we look at the world, we look at private real estate debt as growing over the next decade like direct lending did over the last. One last comment I'll make, you look at what's happening right now from a macro perspective with the Trump administration stance towards funding universities and what it's forcing some of them to do with their endowments. You were seeing secondary private equity attract a lot of interest because people are selling exposures of primary private equity positions, and as a buyer, that turns it into a buyer's market. I can be more selective in what I buy, and I can buy at better pricing than I could have a few months ago.
It's almost like what you're seeing in sports as well, with private equity getting involved, especially with NIL and so forth, and how they're looking to back different programs, which I think is interesting in the panel itself.
Changing a huge way in which we operate just globally from a sporting ecosystem, without a doubt.
Can I ask you a quick question?
Yeah, of course.
So in Blackstone's recent earnings release, they said they had $177 billion of dry powder that they had not yet invested in private markets, which shocks people until you read 2023 was $200 billion. Yeah. So it's come down. Why do you think it's so difficult to put money to work?
Yeah, I can't necessarily speak for Blackstone as a company, but if I think about the dry powder in primary private equity, it's because so much has been raised over the last decade. Exits, IPOs have slowed. Yep. M&A has slowed because of the macro uncertainty, and so you're not getting liquidity out of the back end of your portfolio, which means you're cautious on deployment on the front end, especially if you think pricing is going to come down. For us, one of our businesses that we don't have a direct primary private equity business. We have a secondary private equity business, Lexington Partners. And one of the things we see is the trends I just discussed leading to more people looking to sell to us because they have to artificially create liquidity to the primary PE positions. And from our seat, the more people that have to do that, the more selective we can be, the more pricing power we can extract. And the RIA community has really gravitated to that asset class because it's a way to scale their exposure quicker. That's the other big part about private markets is if you don't have a exposure, it takes 5, 6, 7 years to build the right size exposure unless you use these new vehicles we're all creating together, these semi-liquid vehicles.
Yep.
Yeah. And a couple minutes ago here, do you think there's any risk of overcrowding in this space?
No, I mean, it's a competitive market, right? And so you have new issuers. It's a lot easier, especially on the liquid side, where you can launch an ETF and new managers can come out with product. And what happens then is the best product ends up typically winning. I mean, not always, right? First mover advantage is a real thing. To your point of what's working in privates, what's working in the ETF landscape has been derivative income strategies, whether it's buffered ETFs or it's covered call ETFs like we have, but they're nuanced in their exposures and the use cases. And so I think you had a tech sell-off in July, August last year, you're in the current sell-off now, so you're actually seeing what these products are doing and how they work in varied environments. And so what's going to come from that is people are going to gravitate towards the ones that are working the way that they've been designed to and the way that people have explained them. And I think the best part about all of this in terms of education from an RIA's perspective is that they end up becoming more outcome-oriented with their clients. Right now there's so much investment choice that you can truly cater what your end client's needs are and build a portfolio around that. And I think that's really unique versus what's historically been the case. We all know, you talk to clients and equity markets are ripping, the benchmark's the S&P 500 and your clients are probably somewhat upset because you haven't returned 30%. if markets are selling off, why do I have any loss at all? And so this, all of a sudden, to your point, it's like, oh, this product delivered 1%. Does that feel good? I don't know. I think it feels good. Should it feel good? You kind of create this very specific, unique goal set, and then you operate based on what your actual clients' goals are.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.